Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Calb Group Co. Limited quarterly report. Calb Group Co. Limited is a new energy technology company that offers a wide range of products and services to various markets around the world. The company specializes in designing, researching, developing, producing, and selling electric vehicle (EV) batteries and energy storage system (ES) products. The company's product offerings cater to different markets, including passenger vehicles, commercial vehicles, energy storage systems, and emerging markets. This indicates that Calb Group Co. Limited is a diversified business with multiple revenue streams. By serving various sectors, the company has established itself as a key player in the new energy technology industry. In terms of geographical presence, Calb Group Co. Limited operates globally, with a strong presence in mainland China, Europe, Asia, the United States, and other international markets. This extensive global reach enables the company to tap into diverse customer bases and expand its market share. Overall, Calb Group Co. Limited's business model is centered around providing innovative new energy solutions to various industries and markets worldwide. Calb Group Co. Limited market capitalization of $63 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Calb Group Co. Limited holds a significant advantage in their industry. Calb Group Co. Limited trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 1.49 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in an organization can be attributed to various factors. However, based on the extracted summaries, it appears that total operating revenue and cash received from sales of goods and provision of services are key contributors to this phenomenon. Total operating revenue has shown a significant increase of 68.4%, indicating a substantial rise in overall revenue generation. This growth is likely driven by a combination of factors such as increased sales, expansion into new markets, or improved operational efficiency. On the other hand, cash received from sales of goods and provision of services has experienced an even more dramatic surge of 106%. This suggests that the organization's ability to convert sales into actual revenue has improved significantly. While it is difficult to pinpoint a single primary driver of revenue growth or decline, these two metrics provide valuable insights into the underlying factors contributing to this trend. By examining these key performance indicators, organizations can gain a better understanding of their strengths and weaknesses, enabling them to make informed decisions about future strategies and investments. The net income and profit margins of a company have undergone significant changes in recent years. A notable increase of 64% in net income has been observed, indicating a substantial growth in the company's financial performance. This upward trend is also reflected in operating profits, which have risen by 65%. Furthermore, both operating profit margin and net income margin have seen an improvement. The operating profit margin has increased from 4.9% to 7.5%, while the net income margin has risen from 4.9% to 7.3%. These increases in profit margins suggest that the company is becoming more efficient in its operations, resulting in higher profitability. The significant growth in both net income and operating profits can be attributed to various factors, including improved operational efficiency, increased revenue, or strategic business decisions. The company's financial performance is a testament to its ability to generate significant positive cash flow from its operating activities, as evident from the net cash flows from operating activities, which amount to $3,055,234,290.50. The company is successfully converting its profits into cash. This positive trend is further reinforced by the net increase in cash and cash equivalents, which stands at a substantial $3,667,881,668.13. This indicates that the company's operating activities are generating sufficient cash to not only cover its expenses, but also build up its reserves. Overall, these figures suggest that the company is indeed generating positive operating cash flow, a key indicator of financial health and stability. The company's debt level and interest expenses have undergone significant changes in recent times. While short-term borrowings saw a modest increase of 6.5%, long-term borrowings took a substantial hit, decreasing by 12.3%. This mixed trend is further reflected in the overall liabilities, which decreased by 7.1%. However, it's the interest expenses that have seen a more pronounced impact. Finance costs skyrocketed by an astonishing 169.7%, while interest expenses rose by 65.4%. These significant increases suggest that the company is now shouldering a much heavier burden of debt repayment and interest payments. That concludes the financial summary for Calb Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.